Okay, let's dive right into this. Welcome to The Explainer. Today, we're moving way past those mechanical basics, just hitting the buy button on your phone and hoping for the best. We're going to truly unpack the core mechanics of the stock market and, more importantly, the mindset you absolutely need for long-term investing. If you've ever stared at a flashing green or red ticker symbol and thought, what is actually happening beneath all of this? Well, you're in the right place. So here is our roadmap for today. First, we'll look at primary versus secondary markets. Then supply, demand, and price. After that, price versus intrinsic value. Fourth, we'll cover the 7 faces of risk. And finally, we'll wrap up with diversification and discipline. All right, section 1, primary versus secondary markets. Let's start peeling this investing onion right from the outermost layer. There's a really common misconception out there that when you buy a stock, your money goes straight into the company's bank account. But actually, that depends entirely on which market you're playing in. In the primary market, think of an IPO, an initial public offering. That is where your money goes directly to the company to fund their operations or research or a big expansion. But the secondary market, that's what most of us are interacting with every single day. When you buy shares of some massive tech company on your brokerage app, you are typically just trading previously issued shares with another everyday investor. The company itself doesn't see a dime of that specific transaction. You're just swapping ownership claims with someone else. Moving right along to section 2, supply, demand, and price. At the most fundamental level, stock prices move because of good old supply and demand. If everybody wants a stock and no one wants to sell it, the price shoots up. Conversely, if everyone's rushing for the exit and sellers outnumber buyers, the price plummets. And this tug of war is visualized perfectly through something called the spread. The spread is literally just the gap between the bid, which is the absolute highest price buyers are willing to pay, and the ask, the absolute lowest price sellers will accept. A trade only happens when a buyer and a seller finally blink, agree, and cross that gap. But that brings us to a really crucial question. If short-term prices are just bouncing around based on the immediate supply and demand of traders crossing that bid-ask spread, how on earth do we know what a company is actually worth? I mean, is it all just a massive guessing game? Which takes us perfectly into section 3, price versus intrinsic value. Okay, if you remember one thing today, make it this core concept. A stock represents partial, real ownership in an actual business. The stock price, well, that can swing wildly in the short term just based on sentiment, a news headline, or liquidity. It's really helpful to think of the price as a fast-moving shadow. The actual business fundamentals, the company's real earnings, their debt, the cash flow, that is the slow-moving object that's actually casting the shadow. Over the long haul, a company's business performance and its stock price are deeply, deeply connected, even if that shadow is just dancing around erratically in the short term. And this brilliantly illustrates exactly what your ownership claim looks like compared to, say, a lender's. Imagine a company owes $100 in debt. If the company makes less than $100, the lenders take whatever cash is there, and the stockholders, they get absolute zero. But if the company knocks it out of the park and generates massive profits, the lenders still only get their fixed $100. As an equity holder, you get literally everything else. It's what we call the residual claim. You absolutely carry more risk because you're the very last person in line to get paid, but your potential reward, it's practically limitless if the business thrives. And these concepts plug directly into how we actually analyze investments. Basically, you've got 2 main camps. Technical analysis focuses entirely on the shadow. They look at price action, volume, and chart patterns to try and predict short-term momentum. Fundamental analysis, on the other hand, focuses on the object. It looks at the company's financial health, their revenue, their cash flow, all to find the fair intrinsic value of the business. For beginners looking to build serious long-term wealth, fundamental analysis is absolutely key. It ensures the price you're paying actually makes sense compared to the real business generating that residual cash flow we just talked about. Which leads us to section 4, the 7 faces of risk. So the crucial point here is that risk in the stock market isn't just one big, scary, monolithic thing. It actually has many faces. It's not just company risk where, say, one specific business goes completely bankrupt. No, you also face market risk where the entire stock market takes a nosedive. Then there's valuation risk. This means even if a company is truly fantastic, you could still make a terrible investment if you just pay way too much for it up front. And of course, macroeconomic risk. Things like inflation, recessions, or unpredictable interest rates. Understanding all these different faces is literally step 1 to actually managing them. And that brings us to our final section, section 5, diversification and discipline. let's talk about concentration risk versus diversification. Look, if you put every single dollar you have into one stock or one specific industry, a single piece of bad news can wipe you out completely. That's concentration risk in a nutshell. Diversification is the simple, powerful act of spreading your investments across different asset classes, sectors, or companies. Now, let's be clear, it doesn't eliminate risk completely. Honestly, nothing does. But it drastically minimizes the damage any single failure can do to your overall portfolio. It is the absolute structural foundation of your defense. But here's the thing. A strong structural foundation means absolutely nothing if the architect panics. The stock market is heavily influenced by human psychology. Flashing red numbers on a screen can induce intense, irrational fear, while those soaring green charts can trigger extreme greed. Emotional discipline is your ultimate defense mechanism. It means not overtrading. It means ignoring the hype of the crowd. And most importantly, it means sticking to your long-term plan even when the market feels like an absolute roller coaster. To tie this whole explainer together, I want to leave you with a really powerful quote drawn directly from our sources today. It goes, "The stock market is not simply a place to get rich quickly. It is a financial system that allows companies to access capital and investors to participate in business ownership." Remembering that fundamental truth is exactly what helps cultivate the patience, the education, and the ethical mindset you really need for true long-term success. So we peeled back all the layers of the onion. You know the difference between the primary and secondary markets. You've seen how supply and demand drive that short-term spread. And you hopefully understand the massive difference between the fast-moving price shadow and the slow-moving business fundamentals actually casting it. You know the risks, and you've got the tools to fight them. So the only question left to ask yourself is this: are you investing for the next day or the next decade? Keep learning, stay focused, and I'll catch you in the next explainer.